So let's start the class. We have studying the IFRS 5 non-current asset held for sale and discontinued operations. And in the last class, we have talked about a non-current asset held for sale. What is the criteria to treat an asset or group of asset as held for sale, how it will be measured, and how the group of assets classified as held for sale would be presented in financial statement. Now, in this class, first of all, we will talk about the remaining part of IFRS 5 asset held for sale and discontinued operations. Now, we were left with the discontinued operation. First of all, let's define that what meant by the discontinued operation. Dear student, discontinued operation, it's a component. It's a component of the entity which is being disposed or classified as held for sale, and it presents the following. Number one, a major separate product line or a geographical area. So component of the entity, you can say a segment of the entity, or you, in a simple word, you can also relate it as a cash generating unit. And that cash generating unit or that segment is being disposed either or If it is not being disposed, it is classified as held for sale. Now, for example, if a company is manufacturing three major products, and when we say major, let's say it is their 10 to 15 or 20 or 30% of their sales, and they decide that now they will withdraw that product from the market. They would not sell that product anymore, or they would not sell that product or uh, supply that product in a particular geographical area. Now that operation will be classified as a discontinued operation. Or number two, it's a part of a coordinated plan to withdraw withdrawn a major product line or from a geographical area. Or you have a coordinated plan where you have basically make a plan of restructuring, and in the result of that, you are withdrawing uh, your major product from a product line, or you are withdrawing your product from a uh, geographical area. That coordinated part of that coordinated plan would also consider as a discontinued operation. Or number three, or it's a subsidiary, or it's a subsidiary acquired with the view of resale. You have acquired a subsidiary, and the purpose of acquiring the subsidiary is that you will sell that subsidiary in the coming 12 months. Then that subsidiary would also treat it as a discontinued operation. So this is the definition of a discontinued operation. And if that definition is fulfilled, any of the criteria, then that operation will be classified as a discontinued operation. And most importantly, if it's a discontinued operation, then it will be, or you can say more precisely, its profitability will be presented separately in profit and loss account from the discontinued operation. That will be the presentation requirement of a discontinued operation. That if we have a discontinued operation, then the profitability related to that discontinued operation should be presented separately in profit and loss account from the continued operation. It could be in a single line, or we can show a detailed profitability. When we say a shared detailed profitability, that means along with the continued operation profit and loss account, will also prepare the profit and loss account of a discontinued operation on the statement of on the face of profit and loss account. Or alternatively, we can prepare the profit and loss account of only discontinued operation and present a profitability of a discontinued. We can prepare a profit and loss account of continued operations. This is alternative, and we present the profitability of discontinued operation in a single line. And then, if we are presenting the profitability of the discontinued operation in a single line, then we will make a disclosure in the notes where we will show the details that how that profitability has been determined. But principally speaking, profitability will be presented separately from the continued operation. And the reason is that the profit of the or losses of the discontinued operation would not be available in the next 12 months. So being a user of the financial statement, they must know the impact of the discontinued operation on a future profit in profit loss account. And if we do not present the profitability of the discontinued operation separately, then they would not be aware of that. And they cannot be able to make an informed decision. That's why the profitability of the discontinued operation should be presented separately in a profit and loss account from the continued operation. So that would be the requirement of the discontinued operations. So now, okay. Now let's have a practice question on IFRS 5. You can see a question on the screen. It is started from changes to the group structure. During the year ended 31st September X5, M acquired 60% subsidiary D and also sold all of its equity interest in Barham for cash. So they acquire a subsidiary, that is not point of a concern at the moment, but they also dispose or sell their equity interest in a Barham company. Now come to this last paragraph. The background of this exhibit is that a Barham company has been sold. Now, the directors of M wish advice as to whether the disposal of a B should be treated as a discontinued operation and separately disclosed within the consolidated profit or loss. There are several other subsidiaries which all produce similar products to Barham and operates in a similar geographical area. Additionally, M holds a 52% equity interest in a Watson. Watson has previously issued share options to other entities which are exercisable in a year ending 30th September X9. It is highly likely that these two options would be exercised, which would reduce M interest to 35%. The director of M require advice as to whether this loss of control would require Watson to be classified as held for sale and reclassified as discontinued operations. So we have two entities. One is Barham and the other one is Watson. Keep in mind, we have sold our interest in Barham, but in Watson company, we haven't sold anything, but due to a restructuring of a share capital, our holding from 52% has been reduced to 35%. And that means you have lost the control over the subsidiary company. And it's known as a deemed disposal. This is known as a deemed disposal. You haven't sold it actually, but due to change in capital structure, you have lost the control. So it is known as a deemed disposal. Now the requirement relating to this exhibit is that advise the director as to whether the Watson should be held for sale and whether both it and Barham should be classified as a discontinued operation. So now you need to answer this question. Now how we will answer this question? Dear students, it is relating to discontinued operation and held for sale. So first of all, we will define that what is the meaning of asset held for sale and the criteria to be fulfilled in order to classify an asset held for sale. And then we will discuss the definition of a discontinued operation, which we have discussed here as well today. And then we will apply that definition and that criteria on a given case study. Now, first of all, if we talk about the Barham company, And the requirement relating to Barham companies, that can it be classified as discontinued operation. Now, in order to be a discontinued operation, it should be a major separate product line or geographical area, or it should be a part of a accordingly plan to withdraw from a major product line or geographical area, or it should be a subsidiary acquired with the view of resale. Now, if any of these three criteria are being fulfilled with the respect of the Barham company, then Barham company can be disclosed or can be presented as a discontinued operation in a profit and loss account. But if any of the criteria is not fulfilled, then obviously Barham cannot be presented as a discontinued operation. Yes, it can still present it as a non-current asset as held for sale, but it cannot be presented as a discontinued operation separately in profit and loss account. Now, my question from you, that what is your take on this? That whether the B company, the Barham company, should be treated as a discontinued operation? If yes, what is the logic? And if your answer is no, then also what is the logic behind your answer? You also need to tell me that logic as well. So, what do you think about the B company? Yes, students. Yes, students. Whether we should treat the Barham as a discontinued operation or not. Okay. Why? Why, Avishka? Why we should treat the B as a discontinued operation? Give me the reason. Okay, it's a subsidiary, then it means it's a component. Okay, it's an operation. But in order to be a discontinued operation, it is not only requirement that it should be a subsidiary. It should be a separate product line or a separate geographical area. Or it should be a subsidiary acquired with the view of resale. Now, my next question is, are we as a group of company is withdrawing from a particular geographical area or from a particular product line? Okay, that means you are telling me that we are not withdrawing from a product line or a particular geographical area. Yes, okay. So, if this is not the case, then how we can say that it's a discontinued operation? If the definition is not fulfilled, then how we can say that it is presenting a discontinued operation? Then that means it is not a discontinued operation. It is not a discontinued operation. And if, dear students, if you read the case study carefully, you can refer a point from the case study in your answer. And that is, you have several other subsidiaries which are dealing in a similar product to B, and they're operating in a similar geographical area. So that means withdrawing from the selling of the B does not constitute withdrawing from a product or withdrawing from a geographical area. And it was also not a subsidiary. It is our subsidiary, but it is not that subsidiary which the M company has acquired with the view of resale. With the view of resale. So it is very clear that the B company does not fulfill the criteria of a discontinued operation. So it should not be presented as a discontinued operation. It is not a discontinued operation of the M company. Got it? Yes, students. Got it? Okay. Now, the next thing. What about the Watson company? Now, first of all, tell me, the requirement is, can we classify the Watson as a held for sale and then as a discontinued operation? So, first of all, we have to decide that whether the Watson is held for sale or not. Please, what is your take on that? That is it a Watson company is held for sale? Keeping in mind, held for sale, in order to be held for sale, it should be available for immediate sale, and sale should be highly probable. That means it should be completed within 12 months. Company has an active program to locate buyer. Company has marketed the asset at a reasonable fair value, and it is unlikely that the plan would be withdrawn and the sale will be completed within 12 months, and the management has authorized the sale. So these criteria should be fulfilled in order to classify the Watson as held for sale. Now, reading the case study, after reading the case study, tell me, can Watson be treated as held for sale or not? Yes. Okay, tell me. Okay, tell me. Uh, whether management of the M company authorized the sale? Yes or no? Did the Moyes company authorize the sale of the Watson? Dear student, yes or no? The answer is no. Watson hasn't authorized, the M doesn't authorize the sale of Watson company. Number two, whether the Watson started the search program to search a buyer at a reasonable fair value? Answer is no. They didn't market the asset, they didn't start the program to locate the buyer. because they are not actually selling it. They are not selling it Watson Company. And whether we expect that the sale would be completed within 12 months, answer is no. So there are many notes regarding the criteria which should be fulfilled to classify a company as held for sale or a non-current asset as held for sale. So according to the IFRS 5 criteria of asset classified as held for sale, the Watson company cannot be treated as an held for sale non-current asset. And the reason is that the M is not selling the company. It is basically due to change in a share capital, or you can say restructuring of a share of capital. Your percentage, which was previously 52%, has become 35%. And when you decrease from 50 to 35, you basically lost the control over the Watson. And when you lost the control, that means it is not anymore your subsidiary, and it's constitute a deemed disposal. And it will constitute a disposal. And in this case, it will be a deemed disposal. But this deemed disposal does not fulfill the conditions of IFRS 5 in order to classify the Watson company as held for sale. You got it? Okay. 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 Good. But however, it is a material change. You have lost the control, but it does not constitute held for sale as per the IFRS 5. But here IASB comes, IASB International Accounting Standard Board, and IASB suggests that losing a control over a subsidiary is a material effect. You have no control over the subsidiary, and it's a significant change, and it should be communicated to the shareholder. And in that order, we can treat it as held for sale. So we can communicate it with the shareholder that we have no control over that Watson company. So IASB suggests, okay, IFRS 5 criteria does not fulfill, but you should treat it as a held for sale asset or held for sale company. Okay, because losing the control is a material event. So for fulfilling that requirement, we can treat it as a held for sale. But according to IFRS 5, it is not held for sale. And number two, can Watson company treated as a discontinued operation? Now, in order to be a discontinued operation, it should be presented a major product line or geographical area, or it should be a subsidiary acquired with a view of resale. And there is no information given regarding the Watson company that whether it presents that criteria of discontinued operation or not, that whether the Watson produce a product which means that if we withdraw the Watson company, that means we are withdrawing from the product or withdrawing from a geographical area. But for that purpose, we need information, and that information is not available in that question. So if the criteria is fulfilled, then yes, Watson company can be treated as a discontinued operation as well. But if not, then the Watson company cannot be treated as a discontinued operation. It will be an open discussion with regard of the discontinued operation on a Watson company. Now let me take you the answer. Okay, this is the answer. Kindly read it. Kindly read this answer. So hopefully you have read the answer. You can see that first of all they are defining the things, then they are applying those things on the given case study on B and the Western company. And with regard to Western company, they are explicitly discussing that as per IFRS 5, it does not constitute a held for sale asset. It does not constitute held for sale asset, but losing the control is a significant thing, significant event. So for that purpose, it could be treated as held for sale. Okay. And but in order to classify a discontinued operation, the veterinary company should be a separate product line, geographical area, and it is not discussed in a question whether it is or not. So we will keep discussion open on that. If it present that thing, then it can be a discontinued operation, otherwise not. Okay. Any question? Any question? So now another case study, and that case study will be covering the combination of multiple accounting standards, including 37 and IFRS 5. And that is a question number 2 from December 18 attempt. And you have the question on your screen. So first of all, kindly read the background. Read this area. So for home manufacture white goods such as washing machines, tumble dryers, and dishwashers. The industry is highly competitive with large number of products on market. Brand loyalty is consequently an important feature in the industry. And Farham operates a profit-related bonus scheme for its manager based upon the consolidated financial statement. But recent results have been poor and bonus targets have rarely been achieved. As a consequence, the company is looking to restructure and sell its 80% owned subsidiary, New Wall, which has been making substantial losses. The current year end is 30th June 20X8. Now, the first issue is a factory subsidence. Factory subsidence means that you can say there is some damage to some sort of damage to the property or a building of a factory. Okay, and that is relating to land, deterioration of land. So, a factory subsidence means a worst indicator. That means if I am telling you that it is an indication, that means a damage to asset or a building relating to land issues, that it is a worst indicator. So keep in mind, along with IAS 37 and along with IFRS 5, there might be IAS 36 impairment, discussion regarding the impairment as well. We haven't revised it IAS 36, but we have little bit idea from FR, from F7 about the IAS 36. So Farham has a production facility which started to show sign of subsidence since January X8. It is probable that Farham will have to undertake major repair sometime during X9 to correct the problem. Farham does have insurance policy, but it is unlikely to cover subsidence. The Chief Operating Officer refused to disclose the issue at 30th June X8. Since no repair costs have yet been undertaken, although she is aware that this is contrary to the international accounting standards. COO does not think that subsidence is an indicator of impairment. She argued that no provision for repair to a factory should be made because there is no legal or constructive obligation to repair the factory. Farham has a revaluation policy for property, plant, and equipment, and there is a balance on a revaluation surplus of 10 million in financial statement for the year ending 30th June 2008. None of this balance relates to the production facility, but the COO is of the opinion that the surplus can be used for any future losses arising from the subsidence of the production facility. So there at the marks are 5, we need to discuss the accounting issue here relating to this case study. And there are 3 accounting issues. IF 36 impairment, IF 37 provisions contingent liability and contingent assets. And number 4, suggested treatment of the revaluation surplus, IS 16, property, plant and equipment. Now, first of all, if we talk about the IS 36, according to IS 36, an asset should not be recorded above its recoverable amount. If the carrying value of the asset is more than the recoverable amount, then we should impair the asset. And before we impair it, we need to consider the indication. If there is any indication, then we should review the impairment or we should conduct the impairment test. Now, factory subsidence is an indicator of impairment. Now, the opinion of the chief operating officer that the factory subsidence is not an impairment indicator is not a correct opinion. The factory subsidence is an impairment indicator, and accordingly that the impairment test as per IS 36 should be conducted. Yes, for the purpose of conducting the impairment test, we have to identify a cash generating unit. Cash generating unit in order to conduct the impairment test. And in this case, the factory building is not a cash generating unit. Basically, the total factory, including the plant and machinery, will be considered as a cash generating unit because the factory building on its own cannot generate cash flows independently from the other assets of the factory. So, to conduct the impairment test, the total factory will be treated as a cash generating unit, including the building, land, and the plant and machinery in that factory. And we will calculate the recoverable amount and compare it with the carrying value. And if the recoverable amount is less than carrying value, then the impairment should be recorded. So, first of all, relating to IS 36, we can discuss these points. Number 2, IS 37. Now, CEO opinion that no provision for repair should be made. In that regard, she is right. Because IS 37 prohibits to record a provision for future operating costs like repair expenses. Because there is no present obligation, there is no obligatory to record the repair expense provision. Because we have alternatives. Instead of repairing the factory, we may decide to close down the factory. So when you have alternative, then you cannot record the provision. And the repair expense is a future operating cost. And for future operating cost, there is no past event. So if there is no past event, there is no present obligation. The issue number 3 here is the treatment of the revaluation. Now, we have idea that if you have loss on a particular asset or a group of assets, and regarding to that asset or group of assets, you have a revaluation surplus, then the loss first will be adjusted against the revaluation surplus, and then any remaining loss will be recorded in profit and loss. Yes, it is allowed by IS 16. But here, the 10 billion revaluation reserve does not relate to this production facility. That 10 billion relate to some other asset. So the loss of this production facility cannot be adjusted against the revaluation surplus of 10 billion, which relates to some other asset. So in this regard, the chief operating officer opinion is not a right opinion, is not a correct opinion. Got it? Now, these points which we discussed, we will restructure in the answer in a paragraph form and we discuss these issues. And let me show you that how we will write these things in the exam. Here I have a written answer. Regarding the factory subsidence, and it is started from here. I have highlighted the area. Kindly read it. Kindly read. Okay, now look, a very interesting thing. We have identified IS 36 in this part of the question. We identify the issue of IS 37 and we identified also the issue of IS 16. But there is another standard which has been referred here, which is IFRS 13 fair value measurement. IFRS 13, not in much detail, we have discussed in F7 paper because it's not part of that paper in a detail. But IS 36, 37, and 16, we have discussed in F7 as well. So we have identified the IFRS 36. But IFRS 13 is about the fair value measurement. Now you people know that recoverable amount is higher of fair value less cost to sell and value in use. I'm for a time being, I'm assuming the knowledge of financial reporting. Okay. I'm assuming for a time being that you are familiar with that knowledge. So recoverable amount is higher of fair value less cost to sell and value in use. So to calculate the recoverable amount, you need a fair value. And when you need a fair value, you need to estimate the fair value. You have to measure the fair value. And when you have to measure the fair value, you will be having IFRS 13, which is regarding the fair value measurement, which gives us guidelines regarding the measurement of fair value. So here they are also discussing the implications of IFRS 13. Now, this is the beauty of SBR, that there will be a accounting issue, and being a student, when you are answering the question, you should be able to discuss every possible aspect of the transaction in answering the question. You are discussing the aspect of IS 36, you are discussing the aspect of IS 37, you are discussing the aspect of IS 16. But there is another hidden aspect, which is IFRS 13 fair value measurement. Okay. And we need to develop this habit that when we discussing the answer, we should not be afraid to discuss any other possible accounting issue or the impact of that case study with regard to a particular standard on a financial statement. Like here we have IFRS 13. Got it? And this habit is known as professional skepticism. This habit that, okay, there is a discussion. When I am discussing the answer, there is a discussion about impairment. And in impairment, I am discussing the recoverable amount. And in recoverable amount, I am discussing the fair value. Okay, fair value, IFRS 13. So you can discuss a brief discussion on IFRS 13. This is professional skepticism. And these are the professional marks. Okay, there will be 20% marks in SBR, which are professional. And these are the professional marks that you are using your professional skepticism, and you are showing that professional skepticism in answering your question. You are communicating that. So we also need to create that habit as well, to while we answering the question. And this, how this habit can be developed? This habit will be developed if we answer the question without the fear of mistake. So, okay, if I answer that thing in that particular way, so and if it is not going in that particular way, I will lose the mark. You need to get out of that fear, from that fear. If you do that, then you will generate that ability. Okay. Now you have read it, so there will be no impairment. So there will be no provision because for repair there is no legal or constructive obligation, and we cannot adjust the loss on a factory subsidence against the revaluation surplus, which is relating to some other assets. And I am answering, discuss the accounting treatment which F should adopt to address each of the issue above for the consolidated financial statement. First requirement we are discussing. Now we have the second exhibit relating to, again, first of all, accounting issue. Relating to an accounting issue. The sale of a new watch. Kindly read it. Kindly read this question as well. Okay. Hopefully you have read it. So the summary of the case study is that on 30th June, I said, at the year end, they have a plan to sell a subsidiary. The plan has been approved, reported in the media, and it is expected that Old Castle, the entity which currently owns 20%, will acquire the remaining 80%, and they expect that it would be completed within 6 months by December exit. New Wall is expecting trading losses from a period up to sale, and the accountant of the company want to sell it as a held for sale and to create a restructuring provision which include the expected trading losses, disposal cost, and CEO does not wish to New Wall disclose as a held for sale, nor to provide the expected losses. The CEO is concerned that how it may affect the sale price, and they want to secure the high sale price in order to get the bonus. And the CEO argued that our duty is to protect the interest of the shareholder and maximize their return. And if we show this as held for sale and we do provide the provision, it may affect that objective. And the CEO also threatened the accountant that if you do so, you will lose your job. Intimidate the accountant. The restructuring provision include the future trading loss of 30, legal fees of 2, redundancy cost of 5, impairment losses of own asset 8 million. The trading losses also include early payment of 6 million for the lease asset which deems surplus to requirement. Now, in here, accounting issue one, the IFRS 5, the other is IAS 37. In IFRS 5, we will talk about the classification and the presentation of the New Wall as held for sale. And dear students, it fulfills the criteria of asset held for sale. Asset held for sale criteria has been fulfilled. How it has been fulfilled? The plan has been approved by the board, means authorize the board is committed to sell, they have actively start the program, they have located the buyer, it is expected the sale will be completed within 12 months by December exit. So held for sale criteria has been fulfilled, so New Wall can be presented as asset held for sale, and it should be presented as held for sale. Now, whether it should be presented as a discontinued operation as well, now again it depends that whether New Wall presents a major product line or a geographical area. If so, then it can also present it as a discontinued operation. This is the issue number one. The issue number two is about the recognition of provision, particularly restructuring provision. Now, a restructuring provision should be recognized when the plan has been approved by the board, which has been done before the year end, and that plan has been communicated to the affected employees. And it is also communicated because it is reported in the media. So restructuring provision criteria is also fulfilled. So a restructuring provision should also be recognized. To the chief operating officer opinion that it should not be presented as held for sale, or nor it should be recorded, a restructuring provision is not correct. We cannot stand by the chief operating officer because all of her opinions are against the accounting standards. But she is right on a one point, or you can say partially maybe she is right, that when we are measuring the provision cannot be measured with future trading losses, disposal costs, impairment losses. These amounts cannot be included in the measurement of provision because these are future operating costs. So the accountant is not right if the accountant includes the future trading losses in a provision and impairment losses in a provision. So provision should only be measured equals to legal cost plus redundancy cost and plus a 6 million penalty which they have to pay when they vacate the building early. So this 6 should be also included provision. So total provision of 13 million should be recorded in terms of restructuring. In terms of restructuring. And after reading the answer, we will discuss the ethical issue arising from the scenario, including any action which Farham and the accountant should undertake. So kindly read the answer. Read the answer. Relevant accounting standard, rules and regulations. Being a professional accountant, being an ACC member, it's our responsibility. Now, if we talk about accountant, the accountant appears to have made number of mistakes. If you recall the case study, that he also conducts some mistakes. And being a professional accountant, we does not expect that accountant made those mistakes. Number one, uh, he should be aware of, the accountant should be aware of that future operating cost should not be included in a restructuring provision. And you can say in a couple of time, he is emphasizing that the provision to be made for future operating costs like impairment losses, like um, trading losses. He's emphasizing that it should be included in a provision, but IS 37 does not allow it. Now, this thing shows the lack of professional competence at the end of the accountant. And it is our professional duty that we keep our professional competence up to mark. And ACC has a program for that. That is known as CPD program, Conceptual Professional Development. Once you become a qualified accountant, when you become an ACC member, then it's really your responsibility that you should keep yourself with updated with the changes in the accounting standard, rules, regulation, whatever is relevant. And to fulfill that, there is a requirement of CPD. So, continuous professional development program, and being an accountant, we should attend those programs so we can develop our professional competence over the period. Now, that is with the point of the accountant. But there is another character, which is a chief operating officer. Now, the chief operating officer seems too happy to manipulate the financial statement, and I think he should be happy because her bonuses depend on the targets. Now, if the chief operating officer prepare financial statement as required by the standard, then obviously she has to record multiple losses, multiple expenses, which may reduce the profitability from the benchmark, which is required to have bonuses. So she's arguing, or she is happy to manipulate, not to record the provisions, not to record the companies or the operations as held for sale. Because if she do it, she may lose her bonuses. So she is happy, she is motivated to manipulate the financial statement, and it is against the integrity of the accountant. An accountant should also work with integrity. Integrity means with straightforwardness. Uh, the accountant should not be involved in any fraudulent activity or for his own benefit. So here is the question of integrity at the part of the chief operating officer. And if she lacks the integrity, it would affect also the professional behavior. And due to her professional behavior, the profession may be undermined as a whole. And another issue with regard to the chief operating officer, that she is intimidating the accountant. That if you do record held for sale, or if you do record the provision, even the provision which are required by the standards, you may lose your job. Not, it is intimidating. And you are intimidating, you are influencing, you are using your influence, you are pressurizing someone to do a thing which is not appropriate as per this standard. So she is intimidating, it is also an unethical activity, unethical issue, unethical action, unethical action. And the claim of the chief operating officer that our duty is to secure a good price for our shareholder. Yes, she is right. It's our duty to maximize the shareholder value. It is our duty to protect the interests of the shareholder, but not at the cost of rules, regulations, or with compliance of accounting standards. Protecting the interests of the shareholder is not always mean that you should secure a good price. Protecting the interest of the shareholder, especially to keep the company sustainable, that you should show your compliance with all rules, regulation, and with every relevant accounting and auditing standard. If you're doing it, then your company will be sustainable, and that would be means that you're protecting the interests of the shareholder in a long run, or protecting the interests of the company in a long. So protecting the interest of the shareholder doesn't mean that you go against the rules, regulation, and accounting standards. So here she is also not on the right path. So you can see the chief operating officer on many times, on many occasions, is not working ethically. She is working unethically, which he should not do. He should carry out his duty as a professional accountant with the view that it is her responsibility to make sure that financial statements are true and they are free from any false information or from any manipulation. Now, if the chief operating officer do insist on her demands, then being an accountant, being a professional accountant, what employee can do? First of all, he should talk with her and try to convince her that it is not in the interest of the profession and in the interest of the company to go against the rules, regulations, and do an unethical. And if she understands, okay, but if she does not understand that thing, then accountant should consider other options. The other option may include discussing the matter with the board of directors. In a company, there are NEDs, non-executive directors. The issue should be taken to them. The issue should be taken to audit committee, which is consist of independent directors. Okay, and if the problem is not resolved, the accountant can contact with ACC helpline, which is uh, um, a helpline to help the professional in the situation where the accountant is in a in an ethical dilemma. But when they contact with the ACC helpline, they should keep in mind the principle of confidentiality. So if I'm an accountant, professional accountant, and I am involved in that situation, and I have to contact with the ACC, I will contact with the ACC without mentioning the name of a company, without mentioning the name of my employer. Even maybe I'm not mentioning my name, but I am giving them a scenario. Okay, this is a scenario, and that is a problem. Please advise me that what is the best course of the action. Okay, so these actions the accountant can take. So this is how the ethical issue can be tested in the exam. And in a question number two, there will be an ethical issue. Okay, there will be an accounting issue, and along with the ethical issue, like we have did a question number two here for harm company. Okay, got it? Okay, sir. Now we will take a break. Take a break for 10 minutes, and after the break, we will discuss new topic. Take a break. Okay, students, welcome back. Okay, now we're going to discuss borrowing cost. IAS 23. Borrowing cost means finance cost. It is known as interest cost. Finance cost, interest cost, borrowing cost are similar. Normally, the borrowing cost or interest cost expense out in profit and loss account, in profit and loss account. But as per IAS 23, if borrowings are used to construct or acquire a qualifying asset, then borrowing cost must be capitalized. So if you are using borrowing funds, loan to construct or to acquire a qualifying asset, then borrowing cost will be capitalized. Then it would not be expensed out in profit and loss account. Now, what is qualifying asset? Qualifying asset is an asset which takes substantial time to become available for use. The asset which takes substantial time to become available for use, that asset is known as qualifying asset, like building, plant and machinery, uh, aircraft, fighter jets, ships. These are all qualifying assets. These are all qualifying assets. Or an inventory which needs substantial time to become available for sale or become available for use, that is also a qualifying asset. And if we are using the borrowing or loans to construct or acquire a qualifying asset or to produce a qualifying asset, then the borrowing cost on that loan will be capitalized in the cost of the asset. Then the borrowing cost will not be expensed out, would not be expensed out. Now, when borrowing cost should be capitalized or should be commenced to capitalize, it is known as commencement. Now, there are three conditions. Number one, interest is being incurred. Interest is being incurred. Okay, the interest is being incurred. Interest is being incurred. Number two, expenditures are being incurred on the asset. And number three, all necessary activities are being completed. These three conditions, if fulfilled, then interest cost will start to be capitalized. For example, let's take this is our financial year, 1st January X1, and it's going to end on 31st December X1. Now on 1st January, you take a bank loan, let's say at 10%. At 10%, you have a bank loan. So interest is being started to incur. Then on 1st Feb X1, you get the permission from the authorities to start the construction on the asset. That is the third one. Necessary activities are being completed. And after that, on 1st April X1, you started the construction on 1st April. Now, the 1st April is the date where all these three conditions are fulfilled. Interest is being incurred, expenditures are being incurred, and all necessary activities are being completed. So the interest cost starting from 1st April in the green area, we can capitalize in the cost of the asset. It can be capitalized. And the interest cost which we have incurred in this time phase will be expense out in profit and loss account. From 1st January to 31st March, finance cost will be expense out in profit and loss account. In a profit and loss account. And the interest from 1st April to 31st December will be capitalized. Because all these three conditions, interest is being incurred, expenditures are being incurred, and all necessary activities are being completed. These all three conditions has been fulfilled on 1st April X1. So interest cost from 1st April X1 can be capitalized, and interest cost before these conditions are fulfilled will be expense out in a profit and loss account. In a profit and loss account. Any question? Then there is a concept of suspension. Suspension means due to some reason which were not under the control of the management, the work stopped, like due to monsoon, heavy monsoon, flood, natural disaster, or due to any legal issue, the work has been stopped on the site. Now, the period, the time for which the work is stopped is known as suspension. Now, for example, if in the month of September, let's say in this red area, let's say this is the month of September, and in month of September, due to stay order from the court, work has been suspended. Now, this is known as suspension. Now, if this suspension was not part of the plan, it is out of the box, you can say it is out of the box suspension, then interest cost during that period in the month of suspension or in the months of suspension or in the days of suspension will also recorded in profit and loss account. The month of September interest cost will not be capitalized, will not be capitalized. So interest cost will start to capitalize in the cost of the asset when the commencement criteria is fulfilled. And if during that time period, if there is any suspension, then interest cost we will stop to capitalize during the suspension period. And another thing, when asset is available, substantially substantially completed, not available for use. When asset is substantially completed, we will stop to capitalize the interest cost. When asset is substantially completed or substantially available for use, we will stop to capitalize the interest cost in the cost of the asset, and we will start to expense out the interest cost in the profit and loss. Now, for example, you have started to capitalize from 1st April, then in September, there is a suspension period, but here in the 31st March, this is our year end 31st December X1. But on 31st March X2, the asset is substantially completed. Then maximum up to 31st March interest cost will be capitalized. And any interest cost which is incurred after the 31st March will be expensed out in profit and loss account. Now, this 31st March is a date when asset is substantially completed. When the asset is substantially completed. So after that date, if we are still using the loan, the interest cost will be expensed out in profit and loss account. In profit and loss account. Any question? Okay. Now the borrowing funds which we use to construct or acquire a qualifying asset, these could be specific funds or these could be general funds, also known as general loans or specific loans. So the fund which we are using to construct the qualifying asset could be specific or could be general. General means like bank overdraft, like running finance facility. The funds which are not obtained from the bank for a specific use are known as general fund. Now, if we are using the general fund, we calculate the interest cost to be capitalized equals to average expenditure into average rate. And if we are using the specific fund means the loan is specifically taken for a specific asset. In that case, we will calculate the interest cost, eligible interest cost, and we will deduct any short-term income, and the net answer will be capitalized in the cost of the asset. Now, interest specific uh, eligible interest cost may be $10 and short-term income may be 3, then $7 will be capitalized. Now, what is short-term income? Now, when you take a specific bank loan, bank will transfer the total amount in your account. But obviously, you are not going to use that amount immediately. It will take time. You may use that amount in installment. So funds will be available in bank for investment. So the earning which you will generate by investing those funds is known as short-term income. So we will capitalize the net interest cost in the cost of the asset if we are using the specific fund. And if we are using the general fund, we will be using the average expenditure into average rate. Now the next question is how we will calculate that amount. What are the guidelines to calculate that amount? Now we will discuss that calculation of specific fund and general fund. But we will discuss the calculation in the next class. Okay. I'm going to finish the class now. The calculation we will discuss in the next class, and we will do a couple of questions on IS-23 in the next class, and then we will discuss 1640 and IS-20 in the next class as well, the accounting standard of FR. Okay. So I'm going to end the class here, revise the things which we have discussed, and but I also advise you, if it is possible for you, if you can do it, that would be a good thing. If you can revise IS-16, I'm asking especially from the students who are coming from the stream of ACCA after reading financial reporting FR. If you can revise, do a quick revision of IS-16 and IS-40, investment property, that would be a great thing, because in the next class, I will be doing a quick revision of 16, 40, and government grant. So if you have revised it, then it will be more easy to understand. Okay, because these are the standards which we're not going to study first time. So I advise you to read the 16, 40, and government grant IS-20 before the next class. And in the next class, I will be doing a quick revision of these standards along with some practice questions. Okay, got it? Okay. Okay, done. Great, great. That's great. That's great. You are very motivated, I think. Good. So hopefully you people get the notes and the practice question. Have you got it? Great. Okay, good, great. Okay, student, thank you very much for attending the class, and goodbye and take care. Have a nice weekend.